Welcome back to Let's Invest with the ASX. In this video, we will explore an essential aspect of fundamental analysis, market ratios. Investors employ different approaches to assess companies, including the use of market ratios, qualitative analysis, or a combination of both. Understanding market ratios is crucial in company analysis, even though it's not necessary to memorize them all at once. As you gain experience and read analysts' reports and financial news, you will become more familiar with various ratios. It's advisable to have a basic understanding of available ratios, even if you don't study them in detail initially. Calculating per share data allows for comparisons of earnings, corporate health, and debt in relation to a company's share price. Relating a company's performance to its share price is an essential step in successful investing. According to George Soros's model for reflexivity, a company's earnings strongly influence its share price. As earnings increase and are retained by the company, the value of shares to shareholders and the share price itself tend to rise. However, there may be instances where the share price starts to fall despite ongoing earnings growth. This divergence occurs because the market is forward-looking and anticipates future declines in earnings. Investors may believe that the current share price already reflects the best the company can achieve and start selling to secure profits. Rising earnings attract more buyers and lead to an increase in share prices. Enthusiasm and favorable media reports can push share prices above earnings per share. Over time, the over-optimistic bias is recognized, causing expectations to lower. Lowered expectations lead to prices plummeting below earnings. The reversal of the underlying earnings trend reinforces the drop in prices. Market sentiment stabilizes as pessimism sets in, and the cycle repeats itself. Understanding the impact of supply, demand, and earnings expectations on share prices is important. Market ratios play a significant role in evaluating investment opportunities. Earnings per share, EPS, is an important ratio in company analysis. EPS ratio is calculated by dividing the net profit after tax, NPAT, by the number of shares on issue, representing the earnings generated per share of a company. Analyzing EPS alone may be insufficient, as it may include non-recurring items. Net profit after tax, excluding abnormal items, provides a more meaningful measure. It is important to assess whether dividends were paid from the current year's earnings or from retained earnings of previous years. Checking for a stable or rising earnings stream over many years helps avoid investments in companies that may be liquidated and delisted. EPS can decrease if profits decline or the number of shares increases, which is unfavorable for active investors. Assessing EPS trends, including whether it has been growing or falling, and the proportion of profit derived from ongoing operations is important. EPS alone does not indicate the quality of earnings, and during bear markets, analysts scrutinize earnings quality and dismiss one-off items more critically. Analysis may be more relaxed and less conservative during good market conditions. The price-to-earnings ratio, P/E ratio, compares the share price to the earnings per share, EPS, and indicates how many years it would take for the investment to be covered by earnings. P/E ratios are often based on historical earnings, which may limit their usefulness in determining a share's value. Considering prospective earnings can be more important and practical. The P/E ratio reflects the market's perception of a company's earnings potential. A low P/E ratio compared to the sector average could indicate an underpriced share, a correctly priced share based on earnings quality, or an overpriced share due to unsustainable sector trends. Some P/E ratios may be influenced by faith or hype rather than solid fundamentals, but growth-oriented companies tend to have higher P/E ratios. The P/E ratio should be used in conjunction with other measures, such as return on equity, for a more comprehensive analysis of a company's valuation. Dividend per share refers to the amount of money distributed by a company to its shareholders for each share they own. Merely observing consistent dividend payments over the years is not enough to determine the safety or status of a company as a blue chip. It is important to assess whether dividends were paid from the current year's earnings or from retained earnings of previous years. The payout ratio, or dividends earnings, indicates the percentage of earnings paid out as dividends. The reciprocal of the payout ratio is the dividend cover ratio, or earnings of dividends, which shows how many times the dividends are covered by earnings. If the dividend cover ratio is less than 1, dividends were likely paid from retained earnings. Paying out all earnings as dividends may not always be favorable, as companies may choose to use earnings for expansion, acquisitions, or other growth opportunities instead of distributing them as dividends. In some cases, companies may pay special dividends or announce a return of capital if they have excess earnings that cannot be utilized effectively. Share buybacks can be advantageous for good quality companies and remaining shareholders if funds are used to repurchase shares from the market. Dividend yield represents the percentage of a company's share price that is paid out to shareholders as dividends. It serves as a rate to compare income generated from different investments. While high dividend yields may be attractive, they do not guarantee high dividend payments. The dividend yield is calculated based on the previous year's dividend and the current share price. It can be influenced by a lower share price, indicating expectations of lower dividends in the future. However, pessimism from market participants driving down prices may later prove to be unfounded. The dividend cover ratio measures how many times current earnings cover the dividend paid. It provides insights into a company's ability to sustain its dividend payments based on its current earnings level. Cash flow per share is a financial metric that indicates the amount of cash generated by a company for each outstanding share. Cash flow per share is determined by adding back non-cash expenses like depreciation to arrive at a proxy for the cash earnings of the business. Evaluating a company's cash flow is crucial, especially during economic slowdowns and periods of scrutiny. The importance of cash becomes evident when the economy slows down, and defensive strategies are sought after. Defensive strategies involve finding companies with earnings protected from economic slowdowns, or derived from regions unaffected by the slowdown. Companies with a significant proportion of their earnings in cash or substantial cash reserves are considered attractive for defensive strategies. Cash-rich companies can better withstand economic downturns, continue paying dividends, and reduce debt. Focusing on cash can be a worthwhile endeavor when assessing investment options. Capital ratios. Capital ratios assess how effectively a company utilizes its capital and indicate its long-term stability. The debt-to-equity ratio is a key capital ratio that reflects the company's level of gearing. The debt-to-equity ratio is calculated by dividing the total debt by the total equity. The equity-to-asset ratio is another significant capital ratio that measures the proportion of equity compared to total assets. The equity-to-asset ratio is calculated by dividing the total equity by the total assets. These ratios provide valuable insights into a company's financial leverage, risk exposure, and ability to fulfill its financial obligations. Investors analyze capital ratios to evaluate a company's capital structure and make informed investment decisions. Companies need to determine the right mix of debt and equity financing for optimal funding. Highly leveraged or geared companies have a high proportion of debt in their capital structure. Finding the right mix of debt and equity is a subject of extensive research and academic study. Measures like the weighted average cost of capital help determine the optimal capital structure. Debt is generally considered a cheaper source of funds compared to equity. Higher debt levels can lead to better returns on equity, but erode the company's margin of safety. Excessive debt can compromise credit ratings and increase funding costs if interest rates rise. Striking the right balance between debt and equity is crucial for maintaining financial stability. Assessing the appropriate debt level requires considering potential scenarios, such as recessions or interest rate fluctuations, and their impact on cash flows. Profitability ratios are financial metrics that assess a company's ability to generate sustainable and profitable returns on shareholder investments. Shareholders may not receive all the earnings generated as dividends. Profits can be reinvested by the company. Profitability ratios indicate how effectively a company has earned money on shareholder investments. A company's ability to earn a decent return attracts future funding and favorable attention from the investment community. Profitability ratios are indicators of a company's financial well-being. Generating higher profits allows a company to grow and contributes to sustained price increases. Profitability is different from absolute profits and is measured relative to other aspects of the business, such as equity, assets, or sales. Shareholders bear the risk of a company's ability to earn sustainable profits over time. Profitability ratios provide important insights into the quality of the business and its potential value. Analysts often make adjustments to financial numbers using profitability ratios, such as excluding extraordinary items and accounting for share issues and different classes of shares. Adjusted profit figures after these modifications are referred to as fully diluted earnings. Liquidity ratios. Liquidity ratios evaluate a company's capacity to meet short-term obligations and determine the potential shareholder value in the event of liquidation. Liquidity ratios are crucial for a business's survival, especially during challenging times. The current ratio, also known as the working capital ratio, measures the excess of current assets over current liabilities and indicates short-term liquidity and the ability to meet short-term debt obligations. The general rule of thumb for a current ratio is 2-to-1, meaning $2 of current assets for every $1 of current liabilities, regardless of the strategy employed. Each industry has a different activity cycle length, which is the time between paying for raw materials and receiving revenue from product sales. Longer activity cycles require a higher current ratio. The quick ratio, or acid test ratio, excludes inventory and focuses on assets that can quickly be converted into cash to meet short-term liabilities. Cash and equivalents are crucial in managing cash flow and meeting short-term payment obligations. Interest cover ratio measures how many times the interest expense can be covered by the company's profits before interest and taxes. A higher ratio is generally better, but it could also indicate the company's potential for leveraging and expansion. If short-term assets are less than short-term liabilities, the company may be insolvent, which is an offense under corporations law. Failure to pay debts on time can harm a company's credit ratings, increase the cost of funds, and even jeopardize its existence. Use of fundamental ratio analysis. Capital ratios assess how effectively a company utilizes its capital and indicate its long-term stability. The debt-to-equity ratio is a key capital ratio that reflects the company's level of gearing. Fundamental ratio analysis has limitations due to factors such as data imperfections, data overload, and the potential for information already being factored into the market. Understanding fundamental ratios is essential for long-term investing, as there is a high correlation between a company's earnings changes over 10 years and its share price. Merely understanding ratios is not enough for investment success. It's crucial to develop a method of utilizing ratio information in a logical, consistent, and disciplined manner. Long-term investment strategies may fall into categories such as growth, value, contrarian, momentum, or a combination of these. Strategies consist of carefully researched and selected rules regarding which ratios to use, how to combine them, when to use them, and other aspects such as selling, portfolio weighting, reweighting, and portfolio additions. Contingencies must be considered and covered in the strategy, including actions to take in case of a company takeover, handling funds from the sale of a company, managing received dividends, and determining reinvestment strategies. A carefully planned strategy should provide answers to these questions, and cover various scenarios to ensure effective decision-making. Thank you for watching this segment on fundamental analysis. If you found it helpful, please consider liking and subscribing to our channel for more investment content. Don't forget to use the flashcards to enhance your learning experience. We appreciate your support.